Welcome to the deep dive. Today, we're really digging into Fox Corporation. In this media landscape dominated by streaming giants, you have not to ask about a company like Fox, built on these, well, legacy assets. Is it this resilient fortress with a solid moat, thanks to live news and sports? Or is it more like, I don't know, a melting iceberg in this rapidly warming digital sea? We've crunched the numbers, gone through all the reports, the analyst notes, everything. And our own intrinsic value model points towards, well, some potential upside here. Compared to the current price, around $55.74 as of October 2nd, 2025, our analysis suggests Fox's real value might be somewhere between $65 per share.
Yeah, and that range, it really implies the market's baking in a fair bit of skepticism. Our job today really is to unpack why. What are the big risks, and does the investment case still hold water despite them? So this is going to be a full, comprehensive, Buffett-style look at Fox Corporation, ticker FOX. We're covering it all. From their live content moat, which is substantial, to those huge governance risks that frankly cost them hundreds of millions recently.
Right. We've structured this to make sense. We'll look at the business itself, who's running it, the financials, and yeah, crucially, the risks involved. We're splitting it into two main parts. Part one is that foundational stuff. The business, management, and financials. Then, in part two, we'll get into market sentiment, the interesting ownership structure, risk assessment, and wrap it up with our conclusion. Oh, and before we dive in, just a quick reminder. If you like what we do, please consider liking and subscribing to Stock Analytics AI. Members get priority access to deep dives on all the S&P 500 stocks.
Definitely worth it. Okay, let's get started.
Okay, let's unpack the business itself. Fox's money, it really comes from three main buckets, right?
That's right, three key pillars. First, you've got advertising revenue. This is the traditional stuff, cyclical, definitely sensitive to ratings, political cycles, the drill.
Sure, the ups and downs. But the second pillar sounds more stable, affiliate fees.
Exactly. This is the bedrock in many ways. It's more predictable because it's contractual. Distributors, cable companies, satellite providers, they pay Fox because Fox has content people demand. Think must-have TV. That gives them serious pricing power.
Makes sense.
But they're not asleep at the wheel on digital. The third pillar is content licensing and other revenues. And this is where things get interesting with direct-to-consumer. We saw other revenues jump, 33% in Q4 2025? That's driven by things like FOX Nation, their streaming service, and FOX One, their new bundled digital platform.
And the overall split still leans towards traditional TV.
Yeah, roughly. It's about 55% from the television segment, 45% from cable network programming, still tilted towards broadcast and cable, but that digital piece is growing.
And in terms of what they actually own, we're talking some serious media powerhouses here.
Oh, absolutely. FOX News Media, 23 years is the most watched news channel, reaching 200 million people a month. That's scale.
And sports, FOX Sports, holding rights for the NFL, MLB, FIFA World Cup, those are crown jewels.
Huge. And don't forget Tubi Media Group. They snapped that up in 2020 for what, $440 million?
Right, the free streaming service.
Yeah, the free ad-supported streaming television.
Yeah.
And it's now the most watched fast service out there. Huge library, too, over 250,000 titles. That's their big play, their hedge against people cutting the cord.
Okay, so if we're thinking like Buffett, we need to talk about the moat. What really protects this business?
It really boils down to one thing. Live, culturally significant content. News and sports. Think about it, you have to watch it live. That creates urgency. For viewers and crucially for advertisers who know you can't easily skip the ads.
Right, appointment viewing.
Exactly. And that moat, it's defended by those exclusive content rights you want. The NFL on Sunday. Fox is where you go.
Right.
Plus high barriers to entry, capital costs, regulations, and strong brand loyalty. For distributors, the switching costs are massive. Can they really afford to drop Fox channels and risk losing subscribers? Probably not. That's the power.
Okay, so that's the business structure. Powerful assets.
Yeah.
But who's actually steering the ship? Let's talk leadership. Lachlan Murdoch.
His track record's a bit mixed if you look way back. There was that early stumble with One Tellen in Australia.
Right.
But, focusing on the current Fox Corp, since the spinoff, he's overseen growth to that record $16.3 billion revenue in fiscal 25.
But leadership isn't just about revenue, is it? Especially here. The big test, the defining moment, has to be the Dominion voting system settlement. $787.5 million. That's staggering.
It absolutely is. And it wasn't just the price tag, what came out during discovery, those internal communications. Well, they painted a picture of executives prioritizing commercial interests.
Yeah.
Specifically, the fear of losing viewers to competitors like Newsmax seemed to outweigh, let's say, traditional journalistic ethics or rigorous fact-checking. It exposed a major failure in risk management, maybe even corporate culture.
That's the tough part for investors, isn't it? If that's the decision-making process under pressure, how do you trust the long-term judgment? Doesn't that kind of risk potentially, erode the moat itself over time?
That is the central governance question. It's a significant risk factor you absolutely have to weigh. However, if you isolate capital allocation, purely how they manage money, the story looks different. Management's focus seems to be on M&A that deepens the moat, particularly in digital. Think Tubi, think TMZ, which they bought for $50 million, and now Red Seat Ventures, which is in the podcasting creator space. They're trying to integrate these digital pieces.
And shareholder returns, that seems like a major focus too. They just added another $5 billion to the buyback authorization.
Yeah, bringing the total commitment up to $12 billion, that's huge.
A massive.
It really is arguably their strongest bull point right now. They've effectively retired over 25% of their outstanding shares since fiscal 2020. That's a huge kind of invisible return for shareholders who stick around.
Plus the dividend.
Right, the actual cash dividend.
Yeah.
It's growing 4 straight years of increases, now $0.28 per share. And it's incredibly safe. The payout ratio is just 12.24%. They could easily pay more if they wanted.
So efficient with capital.
Seems so, based on the numbers. Look at return on invested capital, ROIC. It's consistently above 9% and hit nearly 12%, 11.89% in fiscal 25. That suggests that, despite the governance clouds, they are generating real value from the money they invest back into the business.
Okay, let's dig into the numbers, the financial engine here. Looking at the 5-year revenue trend, you see growth, but it's definitely lumpy, right? Cyclical.
Very much so. That huge 16.6% jump in fiscal year 2025, getting them to $16.3 billion, that was heavily driven by predictable but non-recurring events.
The 2024 election cycle spending.
Exactly. Political ad spending and broadcasting Super Bowl LIX, that game alone brought in over $800 million in gross ad revenue. So, yeah, as an investor, you have to look through the cycle, understand those peaks aren't the norm every single year.
Right, but underneath that volatility.
Underneath it, the profitability is pretty strong. Operating margins are getting close to that 20% mark. But what's even more impressive, I think, is the cash generation. Look at free cash flow, FCF. In fiscal 25, it almost doubled year over year, hit nearly $3 billion, $2.993 billion to be precise.
Wow, doubling FCF.
Yeah, in a peak year, obviously. But it just demonstrates the sheer cash-generating power this business has when the stars align with elections and major sporting events.
And that cash flow supports what you called a fortress balance sheet.
Absolutely. They operate with very little debt relative to their equity. That debt-to-equity ratio is just 0.69, very low leverage. And their short-term liquidity, excellent. The current ratio is 2.91. That means they have almost 3 times the current assets needed to cover their short-term liabilities. It's a massive financial cushion.
Which they need, given the revenue swings and potential legal costs down the line.
Precisely. It provides resilience. Now, if you compare this financial strength to how the market sees them, it's interesting. Their trailing 12-month price-to-earnings ratio, the PE, is sitting at 12.6.
Which is low compared to other media giants.
Significantly lower. Disney's PE is over 19. Netflix, forget about it, it's over 50. Fox's PE is even a bit below its own historical average of around 13.
So the market's wary? Pricing in the risks?
It certainly looks that way. There's clear skepticism about the long-term trajectory of linear media and maybe those governance issues too.
Which brings us back full circle to our valuation estimate. Even with that market skepticism, our discounted cash flow model.
Using pretty conservative assumptions, mind you. A weighted average cost of capital, WACC, between 8% and 9%. A perpetual growth rate of just 2% to 2.5%.
Even then, it still points to that intrinsic value range of $60 to $75 per share.
Correct. Which suggests that, based on the fundamentals and cash flow potential, the current price might be underestimating the company's value, or the market is applying a very heavy discount for those known risks. So let's talk about what Wall Street is actually thinking right now. What's the sentiment? Well, the analyst consensus rating is a moderate buy, kind of lukewarm.
Okay. And the average price target?
It's $57.20, so not far from the current price. But that average hides a huge disagreement. The price targets from the 17 analysts covering the stock range all the way from $42 on the low end up to $70 on the high end.
Wow, that's a wide spread, so no real consensus on Wall Street.
Not really. It really shows the division. Some analysts are focused on the near-term cash flow and buybacks. Others are much more worried about those long-term secular declines and governance issues.
What about the technical picture? How's the stock actually trading?
From a technical standpoint, it looks pretty bullish, actually. The stock's trading quite comfortably above both its 50-day moving average, which is around $51.41, and its 200-day moving average. That usually suggests positive momentum.
And short sellers. Are people betting heavily against Fox?
Interestingly, no. Short interest is very low, just 2.83% of the float. That suggests that even the bears, the institutional investors who might bet against a stock, aren't making significant wagers here.
So maybe they see the risks, but the strong cash flow provides too much support for a big short position.
That could be it. It implies a belief, perhaps, that the downside is somewhat limited in the near term, even if the long-term picture is cloudy. All right, let's shift gears to ownership, because who owns the company, and more importantly, who controls it, is absolutely critical here.
Okay, so institutions own a big chunk.
Yeah, about 54.8% is held by institutional investors. And significantly, you see some well-respected value investing firms in there, like Dodge & Cox. Their presence kind of lends some credibility to the long-term fundamental case.
There's always a but with Fox ownership, isn't there? The control structure.
Exactly. This is where investors really need to pay attention. Fox has a dual-class share structure. Class A shares, the ones most people buy, have no voting rights, zero.
So public shareholders have basically no say in big decisions.
Essentially none. And that control is now even more concentrated. There was a resolution regarding the Murdoch Family Trust in September 2025. The outcome. Lachlan Murdoch now has sole voting control over the family's stake. That's 36.2% of the voting stock.
Sole control. Until when?
Until the year 2050.
Wow. Okay, so for the next quarter century.
For the next quarter century, an investment in Fox is fundamentally a bet on one person's strategy, their execution, their judgment. It completely centralizes the power, and therefore the key man risk, squarely on Lachlan Murdoch. Public shareholders are just along for the ride.
Okay, let's pivot directly into those risks then, because they are clearly significant. If we do a basic SWOT analysis, strengths, weaknesses, opportunities, threats, what are the big ones?
Well, the core weaknesses are internal. That heavy reliance on advertising, which we know is cyclical. And of course, the persistent reputational and governance risk, highlighted so starkly by the Dominion settlement fallout.
And the external threats.
The big one, the existential one almost, is the secular decline of linear TV, cord cutting. It directly chips away at those high-margin affiliate fees over time. That's a huge pressure. Plus, just intense competition across the board in media.
And there are newer, maybe more unique risks now. Geopolitical stuff.
Yeah, there's a specific one floating around in 2025, talk of a potential 100% tariff on all movies made outside the U.S. Now, Fox's core business, live news and sports, isn't as directly hit by that as, say, a big movie studio.
Right, they produce less overseas movie content.
Correct. But the indirect effects could still be substantial. Think about retaliatory tariffs from other countries hitting U.S. media exports. Or just a general downturn in the U.S. advertising market if a trade war really heats up and chills the economy. It's systemic risk.
So it's this weird mix. They seem somewhat insulated from certain domestic economic pressures like rising interest rates.
Yeah.
Because their balance sheet is so strong, low debt.
Exactly. They're less vulnerable there than highly leveraged peers.
But at the same time, they're acutely exposed to the disruption of their main distribution channel, linear TV, and now potentially these global trade tensions. It's a real double-edged sword.
It absolutely is. Managing that balance is the key challenge. Okay, let's try to pull all this together, synthesize the findings. The bull case for Fox, what does it really rest on?
It seems to be about the durability of that live content. Moat news and sports aren't going away easily. Plus, the truly massive shareholder return program, the $12 billion in buybacks.
Right. Added the fortress balance sheet, providing stability, and Tubi offering that genuine digital growth engine as a hedge. And based purely on cash flow, the stock does look modestly undervalued.
Okay, that's the bull side, the bear case.
Equally compelling, frankly. You've got the unavoidable structural pressure from cord cutting, hammering affiliate fees eventually. You have the guaranteed volatility of the advertising market.
And the governance.
The governance and reputational risks stemming from Dominion are real and ongoing.
Yeah.
And you absolutely cannot ignore the extreme concentration of control and the key man risk associated with Lachlan Murdoch having sole voting power until 2050.
So our final outlook doesn't really change from the start.
No, it remains consistent. We stand by that intrinsic value estimate of $60 to $75 per share, compared to the current market price around $55.74. The whole investment thesis really hinges on one critical question. Can Fox's powerful cash generation and its competitive moat navigate these undeniable secular headwinds and the known governance risks successfully? Can the castle withstand the rising digital tide before the iceberg melts completely?
That really sums it up. So, considering everything we've discussed today, here's a final thought for you, the listener, to really chew on. Which specific risk do you think will ultimately put a permanent cap on Fox Corporation's valuation multiple? Is it the slow, steady, structural decline of those crucial affiliate fees due to cord cutting? Or is it the potential for more costly governance failures, like the ones exposed by the Dominion settlement? Which anchor weighs heavier in the long run?
It's a tough question. But after this deep dive, you should have a much clearer, more comprehensive understanding of Fox. You know, its structural strengths, its financial cushion, its digital potential via Tubi, but also the very significant, very concentrated risks that come with this investment. It's a complex story playing out at the intersection of media, politics, and technology.
Absolutely. And if getting this kind of deep, nuanced understanding of major companies quickly is valuable to you, please do consider joining us by subscribing to Stock Analytics AI. It's just $4.99 a month, and members get priority access to all our deep dives. We're covering the entire S&P 500 over the next few months, so members get that exclusive first look. Or if you just want a one-off deep dive on a specific stock that interests you, drop us a super thanks. We appreciate the support.
And finally, the important reminder. This analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be taken as financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.